Hi everyone. In this video, we'll be talking about the Philippines. We'll be exploring how foreign investors can access opportunities in the country, and we'll start with a quick country profile and then look at ways to invest through different vehicles. Whether you're just curious about the market's growth potential or you want to understand the basics a bit more, this video will help you get a clear starting point on the Philippines and investing in it. Before we begin, just a quick reminder as always, this video is for informational purposes only, and it is definitely not investment advice. So, to begin with, the Philippines is one of Southeast Asia's most dynamic economies, with a population of just around 115 million people and a median age under 26. This makes it one of the youngest populations in the region, and over the past decade, GDP growth has averaged 6%, which has been fueled by consumption, overseas remittances, and a booming business process outsourcing sector. On paper, this sounds like a very attractive economy with lots of opportunities, but there's considerable accessibility challenges that remain in terms of infrastructure development, bureaucracy, and vulnerability to global shocks. Nevertheless, this combination of strong demographics and consistent growth makes the Philippines a country that global investors should keep on their radar. Before we begin talking about options to invest in equities, an interesting question is why you should be considering Philippine equities in the first place. While the Philippine market doesn't show as much momentum as Vietnam or other countries around the world, valuation, yield, and reforms make the Philippines a credible value income and mean reversion bet. As of September 2025, Philippine equities are priced cheaper than other peers in emerging markets, and this is even true for country specific ETFs, which we'll talk about in a moment. The Philippines also cut stock transaction tax on listed shares from zero point 0.6 to zero point 0.1 effective July 1st, 2025, which greatly reduces trading friction and improves market efficiency. Thus, in some ways, Philippine stocks look relatively inexpensive right now. You're paying roughly 10 times earnings versus close to 19 times in Vietnam. You still collect a small dividend when you wait, and the trading cost just came down after the cut in 2025. If the market regains interest, there's room for prices to move back to normal. For investment options, let's first cover direct investment. While foreign investors technically can directly invest in Filipino equities, it requires a lot of paperwork and it can be quite tedious. Most brokers will require a Philippine tax ID, a valid passport, and sometimes a local bank account. Essentially, if you do not live in the Philippines, opening local brokerage accounts is possible, but it's incredibly paperwork heavy. It can also be challenging if you're actually trying to do this in the country, as you could easily encounter logistical and legal barriers along the way. Check out local brokerage like Cole Finance and First Metro Sec for their current foreign client checklist. For most non-residents, a US listed Philippine ETF or an ADR OTC listing is a much simpler path. There are only a few ETFs that offer direct exposure to the Philippines. For US investors, the iShare MSCI Philippines ETF, ticker EPHE, packages the country's large and mid caps into one ETF. It currently shows an expense ratio of 0.59% and a price to earnings ratio of around 9.87 and a price to book ratio of around 1.2 with a modest trailing yield. So you're buying a relatively low multiple market in a simple wrapper. Cheaper price per unit of earnings can set up better forward return if earnings hold up. EPHE's trailing 12-month distribution yield is about 2.1%. This is not super high, but it is a real cash return while you wait for potential growth as earnings expand or valuations recover. If you have access to European markets, the X-Trackers MSCI Philippines UCITS ETF is a good alternative. Its total expense ratio runs about 0.65%, and it tracks the MSCI Philippines via an accumulating structure, meaning that dividends are reinvested and not paid out. There are also some regional ETFs that include the Philippines in their portfolio, but usually with a very small weight. For example, the Global X FTSE Southeast Asia ETF, ticker ASEA, has an expense ratio of about 0.65% and gives you exposure to the ASEAN 5 region. However, its exposure to the Philippines is relatively small at just 3.8%. Another option is the iShares MSCI All Country Asia ex Japan ETF, ticker AAXJ, includes the Philippines but with an even smaller weight, just 1 to 2%. So overall, your options investing in the Philippines, either directly through country specific ETFs or regional ETFs, are relatively limited. There are also ways to invest in Philippine companies through US tickers in the form of ADRs and OTCs. We'll cover the difference between ADRs and OTCs in another video coming out soon, so here we'll just focus on the companies that you can access. In particular, we'll cover 5 such companies. Philippine Long Distance Telephone Company, ticker PHI-OTC, is the largest integrated telecom operator in the Philippines, covering fixed line, mobile, and expanding digital services. Jollibee Foods, OTC ticker JBFCY, is the country's biggest fast food group with a growing international footprint. Ayala Corporation, OTC ticker AYALY, is a diversified conglomerate with major business in real estate, utilities, infrastructure, and finance. The company is one of the Philippines' most established business groups, and it's available in the US via an OTC ADR. Global Telecom, OTC ticker GTMEY, is a leading mobile and broadband provider and a core competitor to the long-distance telephone company mentioned above. And BDO Unibank is one of the Philippines' largest banks by assets and branch network. There are other OTC options, including Universal Robina, JG Summit Holdings, Metropolitan Bank and Trust, and SM Investments, among others. Again, it's important to recognize what you're actually getting with these. Many Philippine ADRs are trading over the counter or unsponsored, which means lower liquidity, wider bid-ask spreads, and sometimes limited US reporting. It's important that you always check the ticker with your broker, look at live quotes, and do your own due diligence before trading. OTC and unsponsored ADRs can be materially riskier and more volatile than exchange-listed securities, so it's very important that you understand the risk of these before investing. Real estate in the Philippines can also be an attractive long-term investment, but again, it's important that you understand the rules and the risks involved. First, similar to other markets in Southeast Asia, foreigners cannot own land outright. The best legal pathways are to own condominium units that are subject to project-level foreign ownership restrictions of 40% using long-term land leases or investing via Filipino-majority companies. Real estate markets in Metro Manila, Cebu, and some resort areas tend to offer strong rental demand, especially from professionals and BPO workers, but title, permitting, and regulatory details matter considerably. When it comes to purchasing real estate, it's really important that you use a trusted local agent and a lawyer and do your own ground checks and plan for multi-year time horizon. REITs provide a relatively simple and liquid way to invest in Filipino commercial property without having to own physical real estate. Local REITs tend to offer dividend yields at 5 to 7% and are much less work than managing condos or land directly. Access is much easier if you live in the Philippines or already have a brokerage account in the country. If you don't, accessing REITs can be tricky. Another possible option if you're abroad is to get exposure via a global real estate fund that includes Filipino developers. This would be much simpler even if yield and control are lower. Some Asia-Pacific real estate funds and infrastructure ETFs include Filipino developers and utilities such as Ayala Land or MegaWorld, but the Philippines will likely be a fairly small chunk of their portfolio as well. There are some other options available to foreign investors, both inside and outside of the Philippines, but returns may not be as high as other options, and these come with their own complexities. Foreigners living in the country can more readily access local equities via the Philippine stock market, as well as local corporate and government bonds, which will give you a safer and steadier exposure to peso income. However, gains will be modest, and peso depreciation can offset the gains if your expenses are in a foreign currency. For high net worth individuals, some ASEAN-focused PE funds often include Philippine entities as well, and impact investment is growing in the country, but accessing these often requires high investment minimums and dealing with liquidity issues and regulatory hurdles. Foreign investors based in the Philippines can also back startups either through venture funds, angel networks, or equity crowdfunding platforms, but unlike buying stocks or condos, these are high risk, illiquid, and you need to navigate ownership cap restrictions in certain sectors. While the upside can be huge, the failure rate is high, so this path is best suited for investors who can afford to take on venture-style risk. So in conclusion, is investing in the Philippines right for you? While there are opportunities that exist, access for foreign retail investors is still limited compared to other Asian markets. Presently, most options come down to a few ETFs, some OTC equities, or real estate. Property can be attractive for long-term investors bullish on Metro Manila, Cebu, or resort areas, or for those who are interested in the country long term, but these come with their own challenges like ownership restrictions, legal structures that you have to navigate, and rising costs throughout the country. When it comes to equities, Philippine-focused ETFs are currently trading at relatively low multiples, which could be an upside if earnings grow in the future. So in conclusion, the Philippines will likely keep growing, but the channels for foreign investors to currently take part in this growth remain narrow and carry risk. We feel it's definitely a market worth watching, but one to approach carefully. If you found this video informative, please check out Vina Edge for more information on emerging market investing and living. And once again, this video is for informational purposes only, and it is not meant as investment advice.